Four things need to happen for the S&P 500 to continue its advance after 2 straight 20% years. Number one, we need to see low two-way volatility. Number two, the S&P 500 needs to repeatedly get short-term overbought. Number three, we need to see trading box breakouts. And number four, we need to have patterns fail. Of course, when we hear volatility, we think of the VIX. As we've discussed before, the VIX is a helpful tool, of course, but it only measures volatility one way. What happens when the market goes down? The VIX goes up. But we know in the harshest bear markets, volatility is present both up and down. We have sharp moves in both directions. And so a very good way to view this, of course, is tracking the number of 1% moves on a rolling monthly basis. And we've done this all the way since 2022. And so starting with 2022, needless to say, we had a lot of 1% moves, both up and down. And we know the story that we see the biggest daily gains in bear markets, but we also see the highest frequency of big moves as well. Because if you think about it, when do we get a lot of big 1% advances? It's always in response to 1% declines. When we have a strong market, a very consistent market, there's no need to have explosive movement because the declines are infrequent. And when they do occur, they're not big. In 2022, there were nearly 130 1% moves for the year, which is, of course, more than 10 per month. And when that happens, typically have a very tough trading environment, which results in a bear market. And obviously, that's what we got. Finished the year down 19%, but we know it was much worse at the lows. And this is exactly what it felt like and looked like for anyone who's actively trading in the market. So we hear the term that both bulls and bears get hurt. In bear markets, sounds odd, of course, because bear market means people who are bearish typically do well. But the issue, of course, is that the reversals are very strong on the upside too. And it was most relevant here back when market really fell apart in the middle of June, turned on a dime. And of course, this rally was over 20% to the middle of August. As a matter of fact, the S&P 500's vast decline line made a new all-time high right here. So that was enough to convince even the most bearish traders that things possibly were turning higher. Of course, what we saw after that was the last leg of the bear market, which was the worst of them all, bottoming with a huge reversal in the middle of October. So the market was able to rally, fall a little bit by the end of the year. So now we know that was the low, but looking at this alone didn't really give us much confidence that things have really changed. What did we see here? Lower highs, lower lows. It appeared that this was going to roll over one more time. So in 2023, we know things were a lot different, right? Just about half of the amount of 1% moves over the next 12 months, but things really didn't change until April at the start of the second quarter. The S&P was up 24%. Most of that occurred after the March low. And we know that this is what that looked like. So again, rallying from the very beginning of the year, very strong. January topped pretty aggressively in February. And then, of course, that downturn took on a lot of steam when the regional bank crisis was with us. That, of course, ended in the middle of March. And we saw an explosive move higher from that point as well. Now, remember, we had 5 1% losses in March, 6 1% gains in March 2023. Again, most of them in reaction to the downturn that came before it. And it wasn't until the beginning of April when things changed. We can tell this was a major breakout from a bullish pattern. When we got that breakout, more followed. It had a more consistent uptrend all the way until July highs right there. And so we know that there was then an 11% drawdown from August to October. But again, 11% over 3 months is much different than what we saw in 2022. And from that point, the major bottom in October of last year occurred. And we know we ended very well in the final few months in the fourth quarter of 2023. So of course, that brings us to last year, 2024, an even fewer amount in 1% moves. And the only real aberration there was August. And remember, that was a pretty harsh month, of course, but it was really just a few days worth, right? This was about 9% down move, with the last part of it or most of it occurring just in the first 3 days of August. And that was met with what? 7 1% gains after 3 losses to begin the month. We see the trend here. 1% moves happen in clusters. Typically, we see big declines followed by big gains. And in bull markets, those eventually dissipate and we have bullish breakouts occur after that. That's what happened most of last year with another 20% gain. And so that brings us to point number 2. We need to see the market get short-term overbought over and over again. Yes, being overbought is a good thing in an uptrending market. And so looking at the action from the beginning of 2024 on a 2-hour chart, this is the 14-period RSI as well, a few things become evident. Number one, it was really a series of smaller moves all along the way, all between 3 and say 6%, with the biggest move, once again, coming from that August low with those huge amount of 1% gains over the next few weeks. Now, the other part, looking at this from an indicator point of view, each one of these ensuing rallies was strong enough to produce overbought readings on the short-term RSI level here too. Now, most of the time, that coincided with the market making new highs as well. It took a little longer, of course, after the biggest drawdowns from the springtime and summer, but as we know, ended the year very close to 6,100, which was hit on December 6th. And so that brings us to right now, where we've seen the market attempt now to rally twice from the 5850 zone. So far, neither of those efforts have been strong enough to get that RSI reading back to 70. And of course, that means we're below the most recent high as well. And so what do we look for here is a potential change of character. We're not saying that is going to happen, but we are saying that if and when it does occur, then we have to realize that maybe momentum is shifting to the downside. If we continuously see overbought readings and finally they stop happening, even on the shortest basis like this, that could tell us that maybe dip buyers that have been rewarded almost immediately every time may be getting impatient that they are not again. And so if we don't see a new high relatively soon, if we don't see an overbought reading once more, that will be something that we have to watch for. Now, that's important because we're now looking at the latest trading box. And we've talked about this before. Everyone knows about Nicholas Darvis and how we utilize his trading box strategy very much so because it does a very good job capturing markets, whether they're uptrending or downtrending. Because as we know, even the strongest uptrends like we saw in 2024 and 2023 are characterized by periods of consolidation that are resolved to the upside. And that's illuminated very clearly here by the different colors, where as we can tell, there have been a lot more blue versus red all along the way. However, we have seen more red boxes pop up over the last number of months and really from the second half of 2024. But along the way, we've only seen 2 straight downside breaks or 2 straight red boxes one time. And that was in July and of course the beginning of August, which was in the midst of that pullback that of course got very severe toward the end. But even when that ended, it came back and the market continued to rally. We've also framed this within a long upper sloping channel, and this kind of coincided with the S&P getting close to the upper part of that channel. Red boxes developed, meaning that the market pulled back, regrouped, and came back up again. So that leads us to right now, where the most recent trading box, as we can tell, one of the biggest in terms of height right now, and it's all taking place between, say, 6,000 or so and 5,800. And so if we were to get the second downside resolution in a row, creating the second red box, it would mean that we're back below 5,800 again. And as we'll look at in a second, that also would trigger a classic bearish formation as well. So that is the fourth trait we're talking about, failed bearish patterns. And if you think about what's happened over the last few weeks, as we know, things really changed after the election. We had the gap up, and the next few days it was extremely strong as well. But from that point, it's been one big trading range. The way that that has now developed from a technical perspective is a very clear bearish head and shoulders pattern. Talked about this on X a number of times, and at this point, everyone recognizes it. And the first downside break attempt did not hold last week. We saw it, obviously the market opened lower on the first day of the year, but was able to rally back above the potential breakout zone right around 5850. And as of now, the pattern is still in play. it would be negated if we go back above, say, this right shoulder in the near term. If we see a complete rollover, it will be retriggered, and that will give us a downside target right around 5,600. Right? So that's important because recently, what have we seen? We've seen bearish patterns fail numerous times over the last few months, over the last 2 years. And that has been one of the biggest reasons why the market's uptrend has been able to persist for so long. Most recently, we saw one develop right around the end of September into early October. Never quite got completed because just right when that right shoulder was about to roll over, what happened next? Election day, huge gap up. But since that point, another one is formed. As just discussed, the concern is that this rolls over. But keep in mind, there's many more than just these two. Look back all the way to the beginning of 2023. These are all of the major bearish patterns that have come and gone. The only one that saw a successful break, meaning that we got the downside target hit, was back again in summer of last year. And really, this was all about those 3 days in August. It formed the right shoulder, got the huge breakdown, hit the target at the lows on August 5th, and then ripped higher from there. So what will change the market's complexion is something like this, maybe not this aggressive, but continues to happen over and over again. So bullish patterns have been a major part of this uptrend lasting for as long as it has, as well as failed bearish patterns. It just means that the digestive phases have repeatedly been resolved to the upside. So speaking of that, we can take this one step further. And so when bearish patterns fail, bullish patterns get formed and eventually are taken advantage of. And so as of right now, at the beginning of the year, the only target we have in place is 6180 based on the breakout from September 19th, and it has not been visited yet once more. And so we still are about 4 or 5% above that breakout zone. But now remember, the initial bearish pattern that we saw had a target 5,600 or so. So if that does get hit, it would also negate this upside target, which is something we haven't really seen. The biggest bullish formations have not only seen immediate upside breaks, breakouts have been clean, meaning that the breakout zones have not been revisited, especially not after a number of months of being above the breakout zone. So again, looking for some sort of potential change of character, that would definitely be one of them if that were to play out. And so there's other ways to view this as well. So with the most recent failure to get through 6,000, it was also happening as the S&P touched this downtrend line. And if we put that together with this, we could call this potentially a bullish falling wedge pattern. It could be looked at as a longer term pennant formation, or even a symmetrical triangle pattern if it continues like this. So again, we're always talking about classical patterns in terms of head and shoulders, cup and handles, but these are some other ways that the market could leverage a consolidation phase, maybe not in the traditional sense we've seen recently. And so we can end this with some seasonal studies. And so if we talk about studies around the end of the year, of course, Jeff Hirsch, Volmac Trader, does an outstanding job with this. And this was a recent post that he was nice enough to share on Twitter, looking at the Santa Claus rally, first 5 days of the year, and a January barometer. And as we know, Santa Claus rally ended up being negative by a small margin this year. And what Jeff has shown here are the times when the Santa Claus rally was negative, but the January barometer was positive. January barometer means that January itself was positive. And when that has happened in the past, 6 out of the 7 times, it has resulted in gains for the remaining 11 months of the year and the full year. The most interesting part about this is that the last time this occurred was last year, 2024. Right? Santa Claus rally down 0.9%, up 1.6% for January, obviously strong February, and a strong rest of the year as well. So something to keep in mind as we finish out January and head into the rest of 2025. And so also important to realize that we had a lot of new highs last year. And this was a really interesting chart shared by Subutrade, who notes that these were the only years in which the S&P 500 had more than 50 new all-time highs in a calendar year. 2024, 21, 17, and 2014 were the ones that happened in the last 10 years. And so as he shows here, really interesting chart, but historically the S&P tends to struggle in the next year, especially Q2. We can see how this looks here, right? Really a big rollover on average after one of those strong years like we had in 2024. But also of interest is that it typically does tend to bottom in the summertime and then rally toward the end of the year, where we see this, right? Where you have a pretty good November and possibly December as well, even after some potential mid-year volatility. And that leads us to potentially getting another double-digit gain this year. The track, of course, is going to be the question. This was shared by Yardeni Research. This chart just shows the annual gains going back to 1930. This is 20% up for the year, 10%, and the average of 7.2. And what this shows us is that we've had a few clusters over the last 30 years where we actually had 3 straight years or more of double-digit returns. Right? There were 5 in a row from 1995 to 1999, then 3 from 2012, 2014, and most recently from 2019, 2020, and 2021. So is it likely to get another strong year, based on history? Probably not, but it's been more likely over the last 30 years. More importantly, after going through all these slides, we know what the S&P needs to do to log another double-digit gain. That's it for today. Check out these videos and subscribe, and talk to you next time. Thank you.